The outbreak of COVID-19 has had an extraordinary impact on the global economy and triggered widespread social upheaval. Worldwide, clients, investors, analysts, market watchers, and citizens are grappling with uncertainty and in need of insight to guide their decision-making. Starting this week, the Aga Khan Economic Planning Board for the United Kingdom is launching a series of pre-recorded webinars, Managing Through Disruption. Designed to help answer the questions that matter, we discuss the impact that COVID-19 has had on Jamaati businesses, self-employed, and landlords. Jamaati members share their experiences and their unique perspectives on the outbreak's effects and how they are repositioning their businesses for the future. These recordings are available on the.ismaili. You are watching Managing Through Disruption, Creating Liquidity and Managing Costs. On the panel, we have Al Malik, Managing Director of Remarkable Hotels UK Limited and Chairman of Oksana Hospitality. Jamil Mauji, Co-Chair of National Care Group, an adult specialist care provider. Fareen Meghani, FCA, Partner at Fairman Harris Chartered Accountants. Amin Mirali, Director, Retail and Hospitality, Treats Foods Limited. This session is moderated by Hussein Sundaji, EPB Board Member, responsible for alliances.
In the retail department, there isn't much we can do, but what we did was when we had a lockdown, we shut off most of the costs which associated in running the business. So what I mean is the fridge, freezers, all that kind of thing. Everything is switched off. Even when from the sockets, your tills, etc., everything is switched off. So those small things, I know it's very minute, but that's what we did. Air conditioning, if you have it in your shops, some are set on automatics that come on and able to regulate the temperatures. Everything is switched off. So that's all we can do on the retail side. Similar in the hotel, it's pretty similar. All your TVs, all your ACs, your heating systems, your hot water, everything should be switched off. Got to be slightly careful with Legionnaire's disease that there is a possibility if there's no water running. So from what I understand or what little I know, we have to make the water run at least once a week in all the bedrooms and around the property. That's what we did.
So for Alan, I mean, in the retail and the hospitality spaces, you often have a lot of annual contracts in sales and marketing, in repairs and maintenance. So can you just walk us through, and maybe we start with Al, how you went about trying to suspend services for contracts that you already entered into? Are you renegotiating contracts? What have you done?
Well, we're currently negotiating with a few of our software system suppliers. So our PMS system, Guestline, we're still talking to them. We haven't had any full response back from them. What we're hearing through Best Western is that they're giving people they're doing it on a case-by-case situation. So some are getting 25% off their monthly fee, some are getting 50% off. With the hospitality training systems that we have, like Flow, they've decided to suspend all services and not charge us anything. Revenue management systems like Ideas have also suspended the services, so we've been lucky there. Significant cost savings there on that. What else do we use? In the service contracts as well, we have, for example, Tyson Krupp have agreed to suspend their services for the lift maintenance at the moment. So we've had some success there, actually, and so that is obviously reducing cash flow issues for the future.
In early March, we took some steps to review our P&L to look at where we could cost cut. So we came out of any capital commitments. We spoke to our landlord, got a deferment of rent for the quarter. We looked at our staffing and if we could furlough people, what possible redundancies we might need to have in place or to consider and have in the background, opportunities of using freelance staff with less commitments. Our workload has increased significantly, but it's not revenue generating, unfortunately. But we're quite happy to support our clients and right now. So we've taken the view to support our clients as much as we can, and just try and help everyone get out of this situation, as best they can, really.
Thank you. And Jamil, what advice would you offer to businesses that haven't been as impacted as much, and how are you navigating through this crisis?
Yeah, so we're in the adult specialist care market, and probably I know a lot of our brothers and sisters are in it's what we call, I think, the care home business. And I think, yes, our business is not business as usual, but we still provide a key service to society in taking care of vulnerable adults. And therefore, even though our revenues may not have been significantly impacted, our cost sides have. And I think it's important that, and we also have the added, many of our workers are key workers. And so we have the added cost of protecting them and providing a service that not only protects the people we work for and provide services to, but also our staff. And so it's very important that we, again, are trying to maintain costs in that way. But it's also creating a lot of extra work. For example, obviously we have teams going into the various homes. We want to make sure that those teams are segregated, they're protected, they're on their way to work, they're not harassed as a key worker. And so we have had to change our rotoring systems and things like that. It does mean that our costs are going up. So the advice I would give there is to, as many people know, social care was already slightly underfunded. A lot of care homes were being stretched in terms of the excess regulatory aspects were hitting them, and lower fees coming in from local authorities. So this situation has actually increased our cost base slightly. And so it's important that this cost that you are incurring, if there's a way to document it, maintain it, because I think during this crisis, the government is going to see very clearly that adult social care is already was in a somewhat crisis, and that the additional costs here have to be covered in some form. So what I'd recommend is that these additional costs that are being incurred are documented. Keep them available so that when the government does turn to us, which they will, and we're getting a lot of feedback already from local authorities, that you can show that.
Just getting a little bit more what Al Malik said, I spoke to a bank, and it's almost a tick box. If you want a deferment in your capital, they were very happy to do it very quickly. Just a piece of paper came through email, we signed it. It was a 6-month deferment in capital. I think that's across the board with all the banks, and it's something very easily accessible.
And that amortization holiday, that's just being added onto the lump sum of the loan, correct? So you will not need to pay that in 9 months or 12 months.
No. So whatever your term of your loan is, if it's 10 years, 5 years, they just add it on to it and then start amortizing, I guess, when things get better.
And in dealing with lenders, and this is to everybody on the panel, would you guys advise to be looking at your most pessimistic scenario and asking for funds that support you in that instance? Or how would you navigate this with the bank? Would you try to be more optimistic, or would you be quite conservative right now in your cash flows and go with that to the bank?
I think you have to be very conservative right now, especially if you're trying to get the interruption loan. You need to kind of give it the worst case scenario that you can, and just say, we really need your help right now. So that's the position we're going to be taking.
So I agree. I think you've got to be very pessimistic. Try and get whatever liquidity you can from the banks right now, where they're willing to help. In the hospitality, we can see, and it's quite clear to them and to us, that it's going to be the most difficult industry to spring up again. So I'm projecting to the bank that it's 18 months before we get back to 90% of normality. And I think that they will accept that. Retailing too, it's the same thing. Day one you open up, you're not going to trade at 100%. So we're going for the worst case scenario. Let them come back and say no. Usually they don't. It's the other way around. they say this is what you want, and okay.
If I may just add to that, I think given what Farine has said and Amina said about the amount of information needed to even get these loans, and I don't think you want to go through that twice. So I think you want to be as pessimistic and conservative as possible. So you do it all at once, because you don't want to go through the same process twice in 7 months. Have to go back to the bank with hand in hat, because that's a different discussion. So I think being very conservative in your approach to the banks is the right way.
Yeah, just to add to that, the banks are obviously, especially with the C-bills loan, expecting that people have already tried to get deferments on other loans they have and done everything they can. So it is one of the conditions that they would expect to be fulfilled. They've also indicated internally that they would expect cash flows to indicate a very strong lack of revenue up until the end of this calendar year, and where people are forecasting not having a lack of revenue that far across, they're not considering them as seriously, because they don't think that they've properly evaluated their business. So I think it's important that people take that on board, that the banks themselves are expecting a low revenue to be shown at least up until the end of this calendar year.
Now, one question I would have is, of course, this government support, the support from lenders is very helpful. Ultimately, it's debt. It needs to be paid back at some point. So, and I know we're going to talk about the recovery, but before we get there, if we can, what advice would you give to our brothers and sisters who may have the ability to take this debt on, but are very unsure of when their revenues are going to return, that will therefore allow them to pay this money back? What advice would each of you give? And Farine, why don't we start with you?
Yeah, I would certainly advise that with the C-bills loan, it's strongly considered. If you repay the loan within the 1 year that the government interest, then there is no cost to you really to having that money. But of course, you are potentially taking on a debt. But the government are guaranteeing that loan for you. So your security that you're having to put behind that is very low. And I think that there's a massive opportunity in that the government are putting themselves behind you to say, we believe in you, we trust in you, we think that you can get this economy back up and running, and we'll guarantor that loan. And, we haven't seen anything like that. I think the last time I saw anything like that or heard of anything was when it was done by Hazraman, when people came from Uganda and the loans were backed with Lloyds Bank, which was something we never see. And I think that there's massive merit in that the government are doing that. And I think people should seriously look at the opportunities there.
As you said, rightly said, that it is debt. We've got to be very careful how we use it. So even if you get the loan, business interruption loan scheme, if in the hotel and you started refurbishing, using the money for those sort of things, you've got to be careful that will the revenue merit that. So I think taking the loan, keeping as a safety net, I believe it's worth it. Interest rates are quite low. Yes, as Farine pointed out, it's 12 months free. If you're able to and things are okay, pay it back. Otherwise, it's just worth sitting on it, even if you don't use it, and saying it's a buffer. We just don't know what's going to happen. I would be very prudent in doing any expenditures, which is unnecessary in business. So liquidity is key. Take the money, keep it, take a view after 12 months and say, let's see what happens.
You have to be really prudent and actually probably sit on that loan for as long as you can. Use as little of it as possible, because it does have to go back, and just keep it as a safety net there within your bank, and just to make sure and keep looking at your detailed P&L and wherever else you can cut and reduce any expenses, and just keep at it, because as time goes on longer, let's say this, we don't know how long the government can even support us for. How long can they go? Can they go longer than 6 months before the country defaults itself? We don't know. So right now, liquidity is key, keeping every penny you can, and really hold it really tight.
They're 100% right. You take liquidity when you can get it, and you buffer it. I think if you are worried about the future, and the way I look at things is I project out as much as I can. You might want to look at your business, what it was before the crisis, look at amortizing that loan within your business plan and say, okay, I was earning £100 a week. I'm making up numbers, so it's easy to understand. I expect revenue to go to 80% of that in the next 2 years after that. Budget yourself accordingly and see if I will be able to cover this loan. Because I think a lot of businesses that are going to get the loan, a lot of them are going to be credit worthy, hopefully. And so if you are concerned about taking the money, totally agree with everyone on the call that we should be taking that money given the interest rates and it's the 12-month buffer. And if you want to comfort yourself to see if you can amortize or pay that loan, maybe take a cash flow view, take a P&L view over the next few years, take a conservative view as a base, use your historical numbers, cut that down a little bit and see if you can make those payments. And then you can work out in your head what kind of payment rates you're going to need to give to the banks. Because if this turns around in 6 months and you've borrowed £100,000, for example, if you've done these numbers now, you can easily go back to the banks and say, actually, I'm going to be able to pay you over 5 years or 7 years based on my initial numbers. So do the work now. You've got the time. Everyone's working really, really hard. We think that working at home is less work, but sometimes it's more. But I think if you have the time to put in the time now and just see, get yourself comfortable that if you are taking this loan, and which I think everyone should, that you will be able to pay it back in the time period you're comfortable with.
Yeah, I just wanted to add that the CBILS loan, just for people to get a picture of whether they would be accepted for it, is to anyone that has a viable business as at 31st December 2019. So by that, and they're looking at around 1.5 times EBITDA in terms of your serviceability of the loan after the disruption happens. And if you have made a loss in 2019, but there's a valid reason, and previous to that you have been profit making, like maybe to do with Brexit or the election or something like that, then that will be considered. But it's all about your viability as at December 19. So they are taking into account that people will have suffered disruption for the whole of 2020.
Thank you.
If I may, Hussein, so depending on the size of your business, last year, I think over £35 billion euros was raised in private debt funds. So there are a lot of private debt funds out there right now looking to support businesses of all sizes, ranging from £1 million investments and significantly higher. My advice on that is you be a little bit careful in looking at this money. The money is relatively cheap. It's between 4 and 8% depending, so not as cheap as the banks. But the issue is a lot of these debt funds are actually looking at this as an opportunity set to take over businesses when things turn around. So if you really need to take this private debt fund money, and there are ones that go even lower than the numbers I've given you that will give £100,000, £200,000 loans, be a little bit careful because these are loans that not like banks who might support you through it. These are individuals, great businessmen, great investors, but they're looking to take over businesses at some point. And so we don't know how long this will last. So unless you are confident in the asset base of your business and the turnaround, this money is a wall of money available, and people are looking. I've been approached 3 times in the last couple of weeks, but just be careful about taking that kind of money.
The interest rates are very, very high, and I'll try to do everything you can to not use credit cards or even some of these high interest debt companies like Iwaka, where they charge, I think, 2% a month or something. So it's too high. Unless you're very, very desperate, I would avoid that at all cost.
I'd agree. Don't use unauthorized lending. Don't give personal guarantees where you have any doubts. Don't go down those roads unless you are absolutely in dire straits. They're a recipe for disaster, and they'll spiral on you